Welcome back to the What's Your More podcast. I'm your host, Quinton Harris. You're dialed in for episode 258. Hey, in this episode, we've got Fed cuts, lower rates, lower mortgages, and more, all in this episode at What's Your One More. Okay, so welcome back to the show. Today is September 19th, the day after the Fed. I think by this point, if you haven't heard what I'm about to talk about in the form of a rate cut, then you're probably living under a rock, or you're just really not in tune to what's going on in the financial markets. But finally, after quite some time, we've had a Federal Reserve rate cut. It's been anticipated. I think everyone was expecting it. The question was, is it going to be a quarter rate cut to the Fed funds rate, or was it going to be a half a basis point cut? And ended up being a quarter basis point as expected in the market. And, some could argue that this was a very forced measure. It wasn't really it was almost like a preemptive measure by the Federal Reserve. I don't think looking at the records of voting, you had 7 of, the voting members saying they didn't want to do it. And, and I think hesitancy would be the word. They kind of did it just because he kind of was forced into a corner, maybe by the media, maybe by the administration. But I think there was a couple things that the market was expecting here. One, that to happen. And then 2, some comments about what's to come, right? Because we've had a lot of mixed bags there at the podium by our friend Podium Powell, which I'll get up there and talk about here in a minute. But the reality is this, is that the markets, we were waiting as a market on a quarter. We were hoping for a half. We didn't get that. So then there was this kind of uproar and rise in the industry of oh my God, why are we retreating? Why are we not getting what we expected? Why are rates not just falling off a cliff and getting better? Well, it's because it was already baked into the market. It's something that was anticipated for quite some time. This is nothing new to the markets. And I think, again, a lot of people are going, well, why did the 10-year yield not go down below 4 and stay there? It was there when they made the rate cut and announced it, and then it went away. Well, I think you could say that that's exactly what happened. And before I talk about that, let's face it, right now, as I'm doing this podcast on the 19th of September, we're currently looking at some of the lowest rates we've seen in over a year. So I don't want our listeners to get lost in what I'm about to say here, and don't get it twisted. If you're looking at a government loan, that's like an FHA, VA, USDA loan, you're below 6%. Repeat, below 6%. If you're doing a conventional loan, you're just below 6 3/8 and 6 1/4. These are low sixes. We were talking about this 6 months ago. We said if we got this kind of rate, we would have massive market movement. Now, I'm not saying that we're not going to have it, but I can tell you, if you look at the uptick of applications, especially on the refinance side, there's significant signs showing that this is the market's appetite and what we've been looking for. And it's here. Listeners, take advantage of that. Agents, take advantage of that. It's almost time we need to go, hey, wake up. A lot of us have been asleep for a long time, but this is the opportunity that we have been really discussing and waiting on, and it's here right now. So, jump into the market if you've been on the sidelines waiting. If you've been thinking about refinancing, get in the market because the rates are there and the timing's now. Now, there's going to be some people that want to get on here and say, yeah, but, until I see lower rates, I'm not going to do anything. Well, yeah, you could, but how many times have we seen the story where I'm going to wait on lower rates and then all of a sudden the rates get worse, significantly worse? And I'm not anticipating that to happen, but history tells us it's very plausible, and we've seen it happen already here just in the last 24 months. But let's go back to this. So the 10-year yield prior to Powell and company going to the podium, after the announcement, drifted down below 4%, which was a significant move because if we close below 4, that's a good sign. We haven't been able to do that in some time. But we got into that good territory of 3.994. It was man, this is going great. And everybody's feeling, kind of the vibes that, wow, we might get there. And then Podium Powell gets to the mic and he does what he does, which is ruin every good thing that we have going right now. And he starts saying things like, well, this rate cut doesn't lead to future rate cuts. It doesn't mean that this is what we're going to do. We did this because, quite frankly, the labor market it's not as good as we thought. It's not as stable. It's actually below. We thought it would be soft, but it's actually below soft. It's actually softer than we thought. And he even went as far as saying that the Federal Reserve is okay with zero net gain in jobs. So zero net gain, meaning that if we don't gain any new jobs and nothing else happens in the market, he's okay with that. Now, for me, that is the most ridiculous thing I ever heard. If you don't see any improvement, you're steady course, no improvement, I'm good with that. I don't think any of us would be okay with our 401k account not going up just staying flat. I don't think any of us would be okay with our children in school not learning anything and getting better and just remaining status quo. I don't think any of us would be okay with doing that in our own lives and our own work. But yet, someone that's in charge of economic policy is okay with that. And I think that was a really dumb comment by Powell, because he followed it up with, well, if you consider the population growth in the workforce, zero gain is actually, that's actually good, because we're actually gaining jobs, but the workforce is creating, but we're not creating more jobs for the people that are currently in the workforce. And I was like, that is the most foolish, that's completely not okay and not good. But it did bring to light a point we've been saying, that it's labor over inflation, right? This is the way that I believe the Federal Reserve is saying, hey, listen, we're setting the tone for, if the job reports aren't good, if they're just below not good, we're not going to cut. But they're going to have to get significantly worse for us to cut. We're going to see starting negative reporting, jobs being taken away. It's like, dude, where are you at? Like, we've been saying that over the last 6 months. These reports, the ones that you're seeing, they're not accurate. They're not real. And then the ones that you are getting from the private sector are real and are accurate, and they're far below the expectations. Like, this is not a good market, right? And the zero gain, you're going to see unemployment rate go up. You're not going to see it remain consistent. It's going to go up. It's going to get worse. The signs are there. We've been pointing and showing where that's at. And I go back to, how the hell can I see that and they can't, right? How can other people see this and they can't? So Podium Powell, for me, I look at it this way. It seems like it's much easier for him to get up there and make comments about like, well, I'm okay if the job market doesn't grow. I'm okay if, just remain the status quo. Well, let me kind of show you some things about why I think he may think that's okay. So we did a little research here. I think this is interesting here. So here's some things that drive me nuts about the FOMC and the the Board of Governors, if you may, up there. It's almost like Camelot, right? And what I mean by that is, it's everything's great in the kingdom, but outside the kingdom, man, it must be good because it's good inside here, right? And the reality is, there's a lot of frustration growing in the workforce. There's a lot of frustration growing in the United States, and there's a lot of frustration growing amongst our citizens with where they're trying to get to, but how they have to get there, and the amount of money that's outpouring in people's budget each month. It's not getting better, right? A lot of that stuff's getting worse on both ends of the spectrum. Income shrinking, the output's increasing, but that's easy when you're a Fed chairman and you're making close to $300,000 a year. It's also real easy when you can say that when you have close to $50 million in filings and earnings being showed, right? And yeah, I'm calling you out on that. So what? You've done great for yourself in life. But the reality is, it doesn't mean your life is the same as everyone else's that you're making economic policy for.
Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Originator. And what they are doing is they are taking real estate agents and they're taking loan officers, and for the first time in history, they're putting them together under one umbrella. They're actually taking two industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this. You're not just an agent anymore. You're a full-service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com.
The reality is, when you look at all these Fed members and you look at the amount of money that they're paid, anywhere from $225,000 to close to $300,000 to be on there, that's a healthy living, supported by the taxpayers of the United States. It's also, if you look at the fact that they can even have, and I know this sounds crazy, but I think I'm onto something here. The fact that they can even have investment strategies around a market that they technically control is the most absurd thing I've ever heard in my life. It wasn't 2-3 years ago when we saw multiple Fed presidents get in trouble for trading on bonds. For God's sakes, trading on bonds, the one item, the one instrument that they control, with just one point of narrative that goes up or down, fluctuates 10 basis points in a day when they go to the microphone, they were able to invest in that. Like, could you imagine if you could predict a ball game, the outcome, what you would bet on that? That's exactly what was going on here. I mean, go to hardrockbets.com. I say that because you're in Florida. And you could predict, I'm going to say tonight's game's Buffalo versus Miami, right? So let's have a little fun with this. If you could predict, oh my God, like, I know what's going to happen because I control the outcome of that game. I think Buffalo is going to win. I think Buffalo is going to win, and the over is going to be over 50 points. Like, if you could do that, you'd bet the damn house on it. Well, that's exactly what these guys are doing, and they got away with it for years. And it wasn't until the tail end of COVID that the government woke up and was like, "Hey, that might be insider trading." Like, no shit. right? That's exactly what it was. And you look at these guys' net worth and all the accumulation they've had. And I know you guys have heard me pick on Bostic on here. I think that I heard him talk about that a little bit, and I heard him talk in person, and you guys know how I feel about him. But the reality is all of these guys have a financial background through academia. And then they took that and they applied it to the fact that they controlled the outcome, and they've all done very well on it. But yet all of them claim, well, we didn't know that we had a middleman that was doing all of that. We didn't know that. I guess where I'm going with this is they've all done very well on their own ability to control some of the markets and the outcomes. And you could say they're betting on it, and they have, and they've done a really good job with it. It's a real easy way of getting up there and dismissing what's going on in the economy when you've kind of controlled your own outcome, and now you're really controlling other people's outcome with some of the mannerisms and some of the policies that you're putting in place. And I think it falls a little short on these guys when they get up there and arrogantly talk like they're doing. There's few that understand what's going on, but the reality is most of them don't. So I get a little heated about that because all they're doing is anti-stimulating the economy, if you may, and hindering the growth. We're not even close to the neutral rate right now. They talk about getting back to neutral. They're not even close to neutral. Like a neutral rate should be somewhere like 3.25, maybe even 2.75. You could argue that, not where it is today at the 3.75, 4 range on there. It's absurd, right? We still have more cuts to go. And then I go on that because if you look at the dot plot map, they said, oh, listen, we're only going to have like maybe 2 more cuts, and then that's it. Okay, another irrational decision. Like, you can forecast that, but yet you're saying, hey, it depends on the data that comes out from the job markets, and are we going to have zero gains or are we going to have negative gains? So a lot of that stuff is a little frustrating on here. But even with all that frustration, look at where we are currently on interest rates right now. I go back to that. We've talked to people, we've interviewed people, homeowners alike. Literally, I want to make sure you understand this. Like, if you were applying for a government loan today, it doesn't matter what mortgage lender you call, you're going to be in the upper 5s. If you're applying for a conventional loan, you're going to be the tail end, lower parts of the 6s. It's a great opportunity to create more affordability. It's a great opportunity to take advantage of that equity position that you have in the home. Maybe pay off some of that higher end debt that you may have been accumulating. It's a great time to do that. I highly recommend it, and definitely want you guys to take advantage of that, because news is going to talk about what could have been, what is, what isn't. The facts are there's great opportunities out there. Take advantage of that and get into that market, because it is a big win. On our next episode, we're going to go and get Dan Habib in here, talk a little bit more about the Federal Reserve. We're going to pick on them a little bit more, but also talk about opportunities that arise from that, because there are some big opportunities that came from the meeting this time, plus future meeting coming up in the next 6 weeks. Till then, hope you guys have a great week. We'll see you the next episode at What's Your One More.
I got one more shot, I'm going to make it. One more chance, I'm going to take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.